Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel. Our next topic is after the close, and I am your host, Kevin Horner. Thanks for being here this afternoon. I've had a little bit of time away coming back to you here on this Tuesday. It's been just 2 weeks since I last hosted. And of course, when we did this last 2 weeks back, we did put on some example trades that have not only executed, but have worked out in favor of those positions. So we're going to review our examples and our example portfolio a little bit here later, and also get into some new opportunities, some new example trades for consideration based on what the market is perhaps offering us. So as usual, we'll do a brief review of the close today. We'll look at our major indices, looking at the S&P 500, the NASDAQ 100, the Russell 2000, and then we'll start to explore ways that we might, as traders, start looking for those opportunities. And of course, if you're not new here, you know that we do that through a bit of a top-down methodology, which I will walk and talk us through as we move forward here. So thanks for being here, everybody. That's kind of setting the table for you all today. We are joined in the chat by my good friend, Rachel Deschelle, so please say hey to her. She'll get to comments, questions I'm unable to, but of course, I want to hear from you, and I'll try to bring your details right back into the mix here, everyone. I, of course, love to incorporate your discussion on topics, so we'll do that as well. If you're not already doing so, please be sure you're following us on X, Kevin Horner CS, Rachel Dash CS, so just DASH there. It's a good way for you to follow us coaches aside of the classes we offer you. Of course, you know we're here from about 9:30 a.m. till 5 p.m. Eastern live on the channel. But outside of the classes we offer you, without a doubt, X is the place to meet up with us so we can engage with you that way if you'd like. So a follow there would be helpful. All right, let's get to our disclosures and then we'll dive right in. So please remember that our conversation here is exclusively informational and educational. We do not make recommendations. We do not make endorsements for a specific approach to trading the market. We will discuss technical analysis today. In doing so, we remind you technical analysis is merely one of your decision-making puzzle pieces. We do not encourage you to base decisions exclusively from technical analysis. We'll also be talking options today. Options do carry a higher level of risk. These are not appropriate investment opportunities for all traders or investors. You do need to be approved to trade options on each account in which you would like to do so. Of course, we encourage you to be familiar with the characteristics and risks of standardized options, which you can find online. You can also give us a call anytime, and we can offer you that copy as well. And then last, as it relates to options, one thing you need to know, we work in a paper money platform here and on the Trader Talks channel. And the important thing as it relates to options there is that in selling options, you will never receive an early assignment in paper money. However, it is a risk you must be aware of as we go forward. So if you are trading paper money accounts, you will never get an early assignment, but as you transition from paper money into live money accounts, you can, in fact, get an early assignment. And in truth, anytime you're the seller of an option, just please remember, you can receive early assignment even if your contract is out of the money. Okay. So I've got the S&P 500 up there, everybody. We did have a close in the red, down about 0.75%, lost 55 points. My candle is red because we closed under our open today. And I think many of you would point out that that's a pretty decent low. I mean, the thing that stands out to many of us is probably that we've busted a bit of a trend line here. If I wanted to capture as many of those tails along the way, then today would have been one of those breakaway maneuvers where we truly took out the manually drawn trend line that I just added. So now the question becomes, are we able to find support perhaps at a horizontal level? And some traders would point out that, yeah, you know, we did get a tail today. We did not close at the bottoms. We rallied off of those lows. However, we are below the 50-day. Today could be I think today would be, let's see, the close here was yesterday, 66.72. So yeah, we were below the 50-day yesterday, above it 2 days back. So on Friday, just looked like a test. Today, it looks like, hey, 2 days below the 50-day moving average. And some of you might utilize that as maybe reasons for defensive actions in your own portfolios. That's an approach that all of us as traders have to define, but some traders would use a close below the 50-day or even 2 consecutive closes below the 50-day as reasons to lighten up their longs as it relates to the S&P 500. Now, many other traders are going to say, you know what? We still haven't made a lower low, Kev. This is in the time frame for many, this level here, horizontal support at around 65.50 looks as likely for a test as anything else. I mean, we broke through, quick retest. We went higher, quick retest right at the 20-day. We broke down after new all-time highs and found that same level. So this would not be a surprise to many traders, right? Because visiting that again could offer more confirmation of trend maintaining. So a very important level resides beneath us at around 65.50 for the S&P 500. Do we visit it tomorrow? Do we break down through that level? Obviously, my crystal ball is busted and pretty well fractured, so I don't know. But I do know that we as traders, if we look at that green line and build our thesis around it, meaning if we open at the green line and bounce, I'm going to take X steps, okay? If we break down through the green line, I'm going to take the following steps. Give yourself that roadmap. Make it easy on yourself to make those decisions in the moment. Commonly, if you've written it all out or at least given yourself some tenets to adhere to, you're going to make it a lot easier to take those action steps. Doesn't mean they're going to be the right ones. It just means it's going to be easier for you to act, and that will give you confidence to take those steps. That's what we're striving for, confidence in our actions, okay? Good call out, John. Let's look. Why not? I'll throw the 100-day up there. Always find a lot of traders say the moving average that matters is the one that's being respected. Well, let's add some heat here back to the 100-day. Yeah, look, we recaptured the 100-day back there on May 12. We threw it to a quick test. Good call out, John. 10 days later, and then boom, we've been up ever since. The last time we tested the 100-day, it only led, to about a 20% rally. Not to say that that's what's going to happen this time, but if you're a trader looking for a supporting reason, a reason to validate the lows in here as potentially holding, well, I think John has given us something to consider. We've got confluence of horizontal support and the 100-day moving average catching up to it. That'll give some confidence, or if nothing else, it gives confluence, right? The more data you have at a single price level, the more likely that level is important to a multitude of traders. That's the takeaway. Great point, John. Okay, let's move on. Checking out the NASDAQ 100. Similar action here. I'm going to clean this up a little bit. So let's let's throw these moving averages, my traditional moving averages back in, the 20, the 50, the 200. Again, we're below the 50-day here. And my ovals were indicative of the tests of the 50. Today, again, day 2 below the 50-day moving average could be getting to that uncomfortable spot for some traders, that spot where some traders would start to lighten up their longs as it relates to the NASDAQ 100. And again, you're not going to see a whole lot of difference here in this chart versus what we saw in the SPX. A lot of consistency here. 2 days below the 50, same essential levels here, right? For horizontal support. Very common that we move off of trending moving averages, find support at a horizontal level thereafter. So this is pretty intriguing as well. Looks very similar to the NASDAQ. We want to get back up above the 50-day. We want to continue the trend. So the longer we stay below the 50-day, the less comfortable that becomes. And that, of course, can lead traders to taking more cash positions, building more cash, and reducing their risk factors. Again, we don't know what's coming next, but what we do know is that the odds have increased for a deeper pullback simply by virtue of the fact that we're below that 50-day moving average, which we have not been below for quite a while here, right? So something to bear in mind. All right. Yeah, Riceberg, think you might be right. With regard to stops kicking in today, we took out some significant levels for a lot of traders. So I'm sure at the open, there was a lot of that. And then, of course, you're going to get some rallies intraday and some movement. We've definitely seen an elevated VIX. The VIX was up 10% today. It did sell down a bit intraday as we were buying up lows and seeing the market kind of rally back. But yeah, it's been a bit of a rough day. Now, obviously, tomorrow we're going to be hearing from a pretty big company. NVIDIA reports after the bell, so that'll have a lot to do with how we finish out the week. Okay, let's see. Okay, let's also peek in on our small caps, which are the actual index that finished positive today. Interestingly enough, small caps have broken deeper. So what we've seen here has been a deeper move through the 50-day, through the 20-day moving average. Notice the expedience over the last week with which we have pulled back. We broke the 50 here and then found a low, and it took off about 5% very quickly in small caps. So not what I'm taking away, and I think what some traders are also taking away, is that the small caps found perhaps their level of support maybe a little sooner than we've seen in the S&P 500 and the NASDAQ 100, and it could very well be tied to what we're expecting this week out of NVIDIA, of course. So keep that in mind. Small caps bouncing a little bit, and it might be tied to the fact that we saw the yields come down or come back a little today. So we're just hanging out. You got to pay attention to this for obvious reasons, because the yields continuing higher and breaking this downtrend would be significant for small caps. It's going to be a headwind on small caps if yields go higher from here, especially if we get above that 4.2. It's possible we could start to see really that pushing down against us in small caps. So keep that in mind as well. Okay, so there's your broad look at things, right? We've, not a great day, continued a little lower, did get some bounces. Again, remember what the market gives us. The market is giving us opportunities to participate in one way or another, and we need to view things as, I don't know that this is going to happen, but the odds of this happening have now increased or decreased based on the recent price action. That's the thing that I like to encourage you all to bear in mind, right? Because as you get less comfortable with the existing trend, then you should be taking steps to get to comfort, right? To find that level of comfort. And when things start to change, well, it's our job to change with the market. If we adhere or stick too strictly to what we think in the face of evidence that goes against what we think, well, that's when we leave ourselves way too overexposed. So that's what we want to work to avoid as well. Now, as far as looking for example trades today, I mentioned off the jump that we're going to look through that top-down methodology. So taking what we know today, we've got the NASDAQ down 1.2, we had the S&P down 0.8. Could they both be at support? Sure. But, and then the semis also down. And yes, the semi move is likely going to be tied to what happens in the aftermarket tomorrow with NVIDIA. But you know what? The likelihood is that a group that won't have a whole lot of action behind it is going to be the small caps tomorrow. Why? Or tomorrow, Wednesday, Thursday, Friday, because NVIDIA, it doesn't directly impact necessarily small caps, generally speaking. There are absolutely going to be participants in that space, dependent upon how NVIDIA reports, that are going to either do really well or do really poorly in small caps. But remember, small caps are driven by a lot of other spaces, right? Not exclusive to tech, whereas the NDX, obviously quite heavy tech, even the S&P, quite heavy tech, but the Russell, not quite as much, and a lot more tied to financials and a lot more tied to healthcare, okay? So now when we start thinking about the sectors on the move, we can always go through and just kind of quickly peek at what's trending so that we get a little bit more comfort with where we should look for our opportunities. And if you don't like chart triage like I do, because I would stand here for hours and look at charts. That's really what I prefer to do all day anyway. But you can always go to the Market Watch, go to your quotes page, look at your 11 sectors, sort by relative strength. Maybe you're looking over the last 5 days, maybe the last month, maybe the last 4 months. Give yourself something to work with. Where is our leadership? Where are our laggers? Where do we want to go for bullish trades? Where do we want to avoid for bullish? And where do we want to focus on if I'm bearish in nature, right? So all of that can be considered through the basic return detail or relative strength, or as I like to call it, chart triage. So energy, kind of mired still in a bit of a consolidation, but a breakout in energy would be notable if we can make some new short-term highs. But remember what that means. A higher move in energy might be tied to oil moving higher. If oil's moving higher, well, then that's inflationary. That's not ideal for the broader market. So there's always a bit of a back and forth, right? All right, quickly through materials. If you're looking potentially for bearish examples, perhaps materials as a group for consideration. We're failing against it. Look at how clean this is with just the 20-day, everybody. We've been below the 20-day for a bit here now. Look at that. So since it broke down in September, we have only had one real test above it. And we didn't make a higher high. We made a matching high, and that led to a new short-term move. So we've been pulling back there as well. So perhaps for bearish examples, it could be materials. We'll keep moving on down the list. Industrials are a little bit sideways in here. Might be opportunity. Some traders could say that we've held the range we've traded in here, going back to early summer, right around July. Look at that level. Yeah, right on the money, pretty much. I mean, just kind of maintaining. So there's a group that has held up well. Perhaps that's an opportunity to consider for a bullish scenario. Today's candle, indecision. A doji where we basically close at where we open. So our open was 1265.9 and our close was 1266.4. So a 50-cent up day on industrial sector here. So that's a little more consolidative. Could be opportunity though. Some of you traders like to find those. Now look at what stinks. How about discretionary? Just fallen brutally today. A big gap move through an area that could have offered support. And then it finished not just down for the day, everybody, but nearly at the low, essentially, of the day. So from bearish standpoint, that could stand out for some examples, potentially targeting as a collective, maybe the 200-day moving average. And then staples, positive on the day, but still not bullish, everybody. I mean, my goodness, I keep thinking, every time I keep thinking that the market is going to start to produce value-oriented scenarios. Hey, tech's not running, semiconductors aren't running, let's move our balances into staples. Your Walmarts, your Targets, your CVS and Kimberly-Clark and so on and so forth. Those companies are not getting the merit. They're not getting the dollars even still. So yeah, this is not ideal for staples in any way, but it is ideal, or at least it stands out, I should say, as not supportive of the idea that the tech trade is over. Because if the tech trade were over, you would think we would see staples being bought up. You might expect some more defensive areas of the market to produce, and we're just not quite seeing it. Now, healthcare is potentially considered one of those groups that might benefit in a defensive posturing of the market. And we've been talking about that in my classes, at least for a long, long time, dating all the way back to when we finally got out of this slop back here. We put on this little consolidation, and we started talking about it in here because we had recaptured the 50-day and held it. And then we built this beautiful ascending triangle, took that out with a gusto move about a week and a half ago, building a bull flag there as we speak. So pretty impressive maneuvering. The interesting thing as it relates to healthcare here is that healthcare, while it can be defensive in nature, it also is accompanied by biotechnology and pharmaceutical, and those can be a bit more volatile. Okay, so pay attention to where you're getting your leadership in those spaces, and remember, we can do that here on the Market Watch page again. but I have selected here just the sectors, but we can also do sector indices. So remember, this is public lists, not privates. So we can go here to our S and do sectors and industries. And then this can give us the view that you might be diving deeper into those subsets of the sector, the healthcare sector. So keep that in mind as well if you're looking for your relative strength opportunities, where they might reside, and so on. Let's do a quick sort out of these just for the heck of it. So look at how many of these are health. So there's some energy leaders up here. And then as we move ourselves down, you do have a few of these staples like beverages, brewers, soft drinks, but look at all the healthcare. There's the basic healthcare sector. There's your supplies, equipment, distributors, facilities. There's your pharma, biotech, etc. There's a lot of good ways to go through this, everybody. Remember to do your top-down analysis. I hope this is being helpful for all of you. I do see we have a survey there in the chat. Thank you for reposting that, Rachel. Always appreciate that. And you all should know, if I don't say it enough, I really do value your opinions, your feedback on all the classes I offer. I'd love to hear from you. So if you take the time to not just give a score, but maybe your comments, happy to take those from you as well. And I will build and incorporate those into subsequent classes. So good way to go about it. Okay, last areas here. Quickly, financials, sitting at support, could be opportunity, right? Technology, oversold, potentially opportunity, but not everybody's going to want to lean into the same trade over and over. And that's why we're going to look at a couple other thoughts here today. And then don't forget, as you're going through all of your reviews, always find, whenever you find stocks that maybe come across one on a chart, you come across one on X, go ahead and just throw them into your watch list and review the watch list consistently. Look for your opportunities to take advantage of these moves. I mean, once we get volatility into the marketplace, then you're likely finding chances to participate once more. Many traders feel a little bit more comfortable off of the highs, broadly speaking, and they like to buy near areas of support, playing for bounces and so forth. And that's what we might very well find. So let's look at some of these symbols we've got to work with. One that caught my eye today was Cipher. Now, CIFR has been had a heck of a run here, right? Let's go back to where we found this base back after earnings in August and just draw a line so that we can estimate or get an idea of how big a move this was. This stock rallied a mere 438%. Now, there's no way we could look for another 438%, but we could take away from the price action we have here that maybe the support here at this low can be held. And if not, okay, fine, we'll move on. We'll admit we were wrong about it, but we could possibly build an example trade that says under 13.5, I don't want to play in that sandbox anymore, but as long as it's held, we can maintain it and we could potentially trade this for a counter move, maybe back into some area of resistance. Is that at the 50-day moving average? Is it at the 20-day moving average? Not sure. Okay, but we could build a trade from that based on a semblance of proper risk versus reward. The other thing we could do real quick is let's just see if this stands out. I mean, this was a significant move, as we know, on a percentage basis, but did we find an area that should be support based on Fibonacci sequencing? And some traders will do something like this, and hey, we're below the 50% line, so some of you might not have comfort there, but that is something to bear in mind, right? So maybe some traders are going to be walking away based on that. Maybe they're just going to say, you know what, I'm willing to take a little bit of a shot. Let's see what we can play with here. So let's do an example based on the stock potentially maintaining that 13.5 and feeling as though that what we've seen is a pullback to a level from which we can get a bounce. Doesn't mean we're going to, but one way that we could look at this. So some traders will step into underlying shares. It's not a cheap, it's a relatively affordable position at only $14 a share, right? So some of you would feel good going ahead with 100 shares, 200 shares, something like that. Nothing wrong with it. We're going to build a bull call spread, though. We're going to do a trade with the idea being that we can participate in some upside, reduce our cost by capping our upside, and see what we can get from this. And again, we'll revisit the trades from a couple of weeks ago here in just a moment. So we are sitting around 14.5. And the reminder I want to give is when we're thinking about these bull call spreads, commonly a trader is going to look for a deeper or larger delta because it offers them a greater dollar for dollar move in the underlying stock, meaning they're willing to pay a little bit more for the upside opportunity because the likelihood is that the contract selected on the call side is going to be in the money at expiration. And that gives them a little bit more confidence, a little bit more comfort to maintain that trade. So when we go in here, we're going to be looking for a ballpark around 60 to 70 delta. That's going to be a 2/3 likelihood of that contract, the long haul, being in the money at expiration. So that means we got to go below where we are currently, something like a 13.5 call or maybe a 13 call. So let's take a quick peek and see what it looks like. And we'll go 2 weeks out. Let me double check here. So we've got nothing to worry about with regard to earnings. That's what led to that most recent pop. And now that we are through earnings and have been thrown back aggressively, I might add, stock sold off to that ledge 46%. So huge rally up, 46% pullback, not a huge pullback in the grand scheme of things, right? But so let's look at maybe 13 and 13.50 2 weeks out. So here's our delta column right here. And if we go to 13.5, it's right at 67. So a 2/3 likelihood of being in the money at expiration. Also, we can expect the 13.50 call to move about 67 cents for every $1 in movement on the underlying stock. All right. So let's go ahead and consider here maybe a $2 tight spread, or maybe 3. We say if we're looking at 13.50 and we want to challenge maybe the 50-day moving average, well, let's make a $3 spread. So we'll see 13.50 to 16.50. So here's how that might look. So just left clicking here on the ask and then going to the 16.50 and holding down the control button, left clicking on the bid. So now we are looking at a 13.50 long call, 16.50 short call. And our midpoint, $1.21, we're going to have to kick this up. So we're going to try and be put into the position. That means we got to give it a little bit of wiggle room, right? So and remember, since we're doing this after the close today, we always should be considerate. Am I willing to pad that limit a little bit? Should I be willing to go as high as, say, $1.35 to put that trade on? And remember, if I'm putting it on for $1.35, what's my maximum? The inverse of the spread discrepancy, $3 less my cost. So $1.65 opportunity, I spend $1.35 to put that on, okay? And that's my max gain, assuming I close the trade in advance of expiration Friday, okay? So $3 spread, total cost of $1.35, $135 for the potential to make $1.65 would be the viewpoint there. So let's build that as an example for about 2 weeks out. Of course, we'll revisit next week as well and see how it's looking. There you go. So that'll be in the mix there. And then I just want to point out, today's volume was a little small, only 14 contracts. And the truth is, we could have gone with higher valued contracts, noting here, the closer we are to the money, the more active they become. But on the long side here, the reason we selected the 13.50 was that higher delta opportunity. Okay. All right. Let me just take a look here. Yeah, I see some of you aren't feeling terribly bullish about the market here, huh? Well, we can certainly, Art, check out a bearish trade. Why don't we give some consideration to that? I've got a bearish chart in here, a few of them at least. Let's see. Let's just work off our bottoms here today. I don't know that we would like to check out Micron for bearishness. That's sitting at the 20-day. That could easily be support. Some of you might be thinking, hey, if that breaks down, I could do a bearish trade, maybe targeting the 50-day moving average. I could see that potentially working out If it got a momentum sell tomorrow, for example, or maybe on the heels of NVIDIA's report on tomorrow afternoon, maybe Thursday, Friday gets to be pretty rough for Micron. That's a possibility, certainly. I'm not going to tell you that you're wrong or right. I don't know. Let's keep moving up my list, though. Maybe there's a bearish one that stands out here. AMD could work. You're well below the 20-day now, kind of mired between the two. Traders try not to overdo it, right? We try to find opportunities that make sense, that stand out right away, as opposed to trying to make something work, right? I often say, if you look at a chart and you have to think more than 5 or 10 seconds, maybe it's not a chart worth trading. So here's Credo. Could be at support, not exactly bearish. What about Toast? We tried a bearish trade on Toast and missed out on it about a month ago. Didn't get ourselves put into the trade, but that's breaking down. That could be an opportunity for like a bearish trade here. And as always, as Rachel's calling out, yeah, time frame matters, of course. What about App? Well, App broke through a level here, and depending on how you feel about gaps, maybe there's a trade on AppLovin from a bearish standpoint. I could certainly see maybe building a long put spread there, or even considering selling a call spread up above, with the belief being that any bounces aren't likely. That, again, this would be the reason that a trader would put one of these on, not to suggest that you should be doing so. But when you look at the low that we made back in August and draw a line through there and catch these other levels, well, what it tells me is that we've broken and had a momentum sell-off. Now, that momentum could be, in theory, at a spot of support, and any bounces could be short-lived, right? Could be counter trend bounces into former support, now potential resistance. So there's a consideration for you from a bearish standpoint. Let's keep moving here. You've got 4. That looks bearish as well. If a trader wanted to build one against the 20-day, that's a downtrend that's been in place for a while, essentially looking at a downtrend since August. That makes some sense. Hey, because if you've ever had trouble validating bear theses, everybody, give a thought to this. You can add in, just invert your symbol. Notice what I did there? I put a little minus sign in front of my symbol. So this is the true chart of 4. Check this out. If you're struggling to validate bearish viewpoints, invert the chart. Now, if I look at 4, this might, for a lot of traders, look like a buy, right? But if you recognize I've inverted my chart, that should maybe give a trader something else for consideration. Try that sometime. If you're trying to get an understanding of what you're seeing and it's just not making sense for you, invert the chart. You might find that helpful. So let's do that. Let's utilize 4. We'll build a bearish trade on 4, working against the same moving average we have essentially been below all the way back to July 31. My goodness, July 30, 31, somewhere in there, right? So let's do that. Let's go bearish on, as an example for 4. Let us build a short. We could sell a call spread above the 20-day. So maybe we sell something near the money, or we could just go ahead and buy a put spread. One of the two. It's really our call if we want to be bearish. Remember, there's a way to be bearish. There's 2 ways to be bearish, 2 ways to be bullish, at least on every position here. So you can always take a long put spread or invert it and do a short call spread. That would also be bearish. So let's consider it a long put spread, utilizing the $70 area as our upside, right? Our long put strike. We can build something like a $10 potential spread and let's see if it goes our way. Now here we have to work with monthlies, so this will be fairly limiting. Unfortunately, one of the things that's immediately standing out is I don't have quite the number of open interest contracts, but it is sufficient for a single contract trade. It won't be a problem, at least. The question is whether I'm going to get a good delta on the call side here. We're trading at 66. Excuse me, I'm not on the call side. I need to be on the put side. We're trading at 66. So we are thinking about the 70, which has a 62-cent delta right here. So that's right about what we're looking for. We would have to buy at 650, and then maybe we targeted the $60 for our $10 spread. And then basically we'd be spending about $5 to make $5, right? Quick math, back of the napkin math there. $5 cost on a $10 spread, $5 to make $5, right? So we'll give that a consideration because, hey, it's not always going to be bullish, right? We often say the market will find there's a bull market available at all times in some aspects of the market. And the same is true about the bearish side of things. So we'll go ahead and put on a bear put spread here, a long bear put spread. So we're going to spend up to $5. One other reminder for you all when you're doing these trades on an overnight basis, yes, I'm building in a padded limit so that I can put the trade on. But if I put that on at $5 and the natural at the open is $4.65, I'm going to fill at $4.65. Remember, when you're placing a limit to buy, in this case, the spread, you're still getting the or better price. You're just saying, I'll take the spread up to this cost. Anything under that cost, I'll take it as well. You're going to get the or better price. So don't feel like you're going to get stuck paying $500, only paying $500 if that's the market, essentially, okay? All right, there we go. So now we've placed a long bear put spread for 4 shift for payments, trending, just following the existing trend, right? And there's nothing wrong with trading the trend, right? That's the trend. The process that so many traders incorporate is just working with the trend at your fingertips. All right, now let's take a look at our example portfolio we put on 2 weeks ago. 2 trades. One was in Danaher, one was in Monster. Both are in, since the open, profit situation, so we're happy about that. Let's look at the Danaher position. So we are in a 210, 220 call. So we are long the 210, short the 220. We've got 3 days to expiration. Let's see where Danaher is on the chart. All right, so Danaher finished at 225 today. So that means we're already 5 points higher than our short call. Okay, we have essentially built a trade that has taken us to max gain in Danaher already. We are, again, it's a $10 spread. Our overall cost has come out, so we are profitable by about 405. Yeah, we could stick with this. All right, you can carry this into the next couple of days, but there's no reason to risk it, right? We have essentially looking at having made $400 off of our overall trade, where we had a maximum. Let's go back to my account statement here, put in DHR so that we can see the original trade. All right. So we spent $525. So that means our max is $475, and we're sitting at essentially $405 right now. So we're really looking at about 80% profit. And I'd say for many traders, we're going to go ahead and take that. Not to say that you have to, but that's a way to look at it. Base hit, nothing wrong with a base hit. So we'll go ahead and sell it. We'll put a limit out there. The mid is 895. If we want to ask for a little bit more, let's ask for a little bit more. All right, let's go ahead to something like 910. All right, let's see if we can't get out at that. So, the max would be 10, right? And eventually, on Friday, you might see that just assuming we hold 225 in price on Danaher, you might very well get there. But we're going to take a little bit less than what max would be. So let's see if we can get out sometime tomorrow here. Actually, I'll make it We'll just leave it good till canceled. That way it takes out any of the next 2-3 days there, right? All right, so hopefully we can get that one taken off. A nice little base hit there in Danaher. And then the other one we put on was Monster. Now, Monster is a 65.70 $5 call spread. And again, we were looking for continuation of the trend. So let's take a peek at Monster. Yep, there we go. So 2 weeks ago, November 4 was our entrance. So November 5, excuse me. The 4th was here. This is when we last spoke. And then the very next day, you got a green candle out of it. Looked like a breakout, right? Looked like a close above the high of the low day. In fact, it was. And yet the very next day, you still had to come back and look at that. Test those same lows we had seen over the last week before it really got going in earnest. But it did. It got going in earnest. We made the trade that worked in our favor. We traded the $65.70 spread. Worked in our favor. We're now 3 points above it. So once more, at this point, when you have traded through the short side of your long call spread, right? In this case, the $70 level. Once we're through that, all that's left in the set of contracts here is time value, and the majority of your move has been made, right? So that is, I'm really glad to hear that, Alfie. That's wonderful. My hope is that the process is what you're taking away from it. I love that it worked out for you, but more than anything, I want you to take away the process. What can we take from price action that tells us about what might happen next? And when we looked last at Monster, it was all of this action settling in at the 50-day. I didn't look at it on the 6th. I was under some serious anesthesia on the 6th, so I can promise you I did not. But if you did look at it and you said, well, goodness gracious, it at least came down to that same level at 66 and bounced, maybe we can hold on to it. And then obviously we had to worry about earnings here. Earnings had a big play in that. The point is, try not to shake yourself out of a trade, right? If you put yourself into this trade on the 4th or the 5th, and you thought you had a trade for a potential $5 call spread to the upside, you built in the trade based on what you thought you were comfortable losing. That's why you spent what you spent, right? Try not to exit a trade early just because you've seen it turn red on you, right? Step into a long spread, long call or long put, and be thoughtful and say, well, I've only spent X dollars. On the Monster trade, we didn't spend a whole lot, right? We didn't. We bought it for, let's make it real quick, and I got to wrap this up for y'all, but we're just going to quickly look here. Monster, we spent $250. So if you stepped into Monster saying, it's $250, I am expecting that to go to zero. That's going to allow you to stick with it regardless, right? If as soon as it moves against you, who cares? You were admitting it up front. That's $250 I can lose. If I can't lose $250, I can't put it into the trade, right? That's the reminder. If I can't lose $250, I can't put in $200. I have to go with the amount I can lose, whatever that is for you. I don't know what it is for you. I only know what it is for me. Okay, whatever that is for me, I look at that and say, I'm putting this trade on, that money can go to zero, and it's not going to hurt my account because the balance of cash is good to go. Okay, that's risk management 101 stuff. Okay, we got to do it that way. Now, so that's where we reside, everybody. There's your Monster. Let's close the Monster trade. I'm going to place an exit strategy there for the exact same thing. Right click, create the closing order to sell the vertical spread. Unloading it at a credit of, we're going to go a little bit higher. Let's go up to 6. Just see if we can get out. Send that for tomorrow, and we will take it. So there you go, everybody. Been a bit of a rough day as it relates to the market, but one of the great things about the use of options when you're a trader is that you are entering well-defined risk strategies. You know your entrance, you know your exit, you know your best case, you know your worst case. It should make it a little bit easier on us as traders. That's the whole process, especially when we're incorporating options and spreads in particular. So Hope this was helpful for you all. We'll revisit them next week. Hopefully we get new trades on with our existing trades of today, the ones we've placed for today. But we will revisit these with you all next week. Now, I'll be back tomorrow morning for Trader Talk, and that is at market open, of course, 9:30 a.m. Eastern. I'm joined by Brent Moore. So if you want to see how we are opening the market in advance of NVIDIA's earnings after the bell tomorrow, that is a great session to attend. I'd love to have you there. Hit that thumbs up down below for me. This will get into the archive, and we'll want to make this available to as many additional viewers as possible, as always. So love to have you do that for me. Don't forget, we have that survey link. Rachel's posted that a few times. Please go ahead and give your feedback. I always value that. If you're going to write any comments in there, I'm going to read them. I can guarantee you that. So thanks for being here. Big thanks to Rachel. Don't forget to follow us on X, everybody. Appreciate your attendance today. Let's do it again real soon. I look forward to catching up with you all again. Thanks.